At the end of 2009, the newly elected Prime Minister of Greece, Georgiou Papandreou, announced to an astonished world that the Greek budget deficit was actually much larger than the official statistics would have suggested. Since then, now almost 4 years later, the Eurozone has been plagued by an existential crisis, the lack of a coherent plan to solve this crisis, and above all, has been suffering from economic stagnation. While many aspects of the economy remain worrisome, we note a few signs of stabilization. First, the swift action of Mario Draghi at the head of the ECB has managed to bring down interest rate levels in Spain and Italy. So far, this is a clear success. Secondly, the current account deficit imbalances, a core reason of instability, are being dealt with in a meaningful way. For example, the Spanish current account deficit, which stood at minus 10% in 2007, basically will be eliminated at the end of next year. Thirdly, the recent economic figures show stabilization in Spain and Italy and point to a recovery in Germany. Let's not be mistaken. 2013 will still be a year of economic contraction. France has not even started with structural reforms, and unit labor costs in Italy remain worryingly high. However, we believe the economy has reached a bottom, and we expect gradual recovery from now on. This is the reason why we have built a significant position in the Euro Stoxx 50. We believe that underweight investors apply an excessive discount to valuation. With this transaction, we have reduced our cash balance, and we now run an overweight equity stance. In addition, we have initiated a position in Russia. We believe oil prices will stabilize around $100 Brent. Valuations are very attractive, and we expect the central bank to cut interest rates in the summer. Last but not least, we used recent correction to add to our Japanese equity position. Looking at the broader picture, the new leadership in China is increasingly recognizing that the growth model based on real estate and commodity-intensive investments is not sustainable, especially if you look at the impact on the environment. Slower Chinese growth plus adequate supply in many commodities is putting pressure on commodity prices, triggering disinflation across the globe. This is good for equity markets. Why? Because central banks are in a position to maintain extreme accommodative monetary policies for longer without triggering inflation. During the up market in equity, defensive sectors have been performance leaders. We expect a change in leadership to the benefit of cyclical sectors going forward. We have positioned portfolio accordingly.